Vinod, good afternoon. Thank you so much for your time. Let me start by taking your view on a commentary just coming from Rajesh Gopinath or TCS here at India Economic Conclave. My colleague Nikunj was having a word with him, and he was saying that, the deal environment, the buoyancy in demand, it continue to exist. Of course, there are pressures on the margin front. We saw a bit of derating move in the large cap IT front. What are your thoughts after this correction has actually happened? Do you continue to see strategic value there? Or do you think this derating could continue some more in large cap IT?
Yeah, good afternoon, Ajay. So, see, IT as such is a long-term story. There is no denying that. I mean, the way IT exports have been rising and supporting the overall macroeconomic stability when we had, the current account deficit rising. So that remains, from a macroeconomic stability, a very important pillar for the Indian economy. Also, it has much higher per capita income in that area with people who are working in this area. And it's showing decent growth, especially in the digitization space. But having said that, I mean, as industry experts and everyone is talking about it's largely driven by high demand for talent there and resulting attrition, which is resulting in margin pressure. So from a short-term perspective, obviously, and because of this optimism around the technology space, the prices were not giving you any great bargains. So if you combine that, I think, from a tactical perspective, it is possible that there might be some correction given the margin headwinds in the short term. But I wouldn't be worried about the long-term prospects of this sector, which is turning out to be a very strong part of the Indian economy for the last several years and going forward. Also, I see that way.
Vinod, we were also talking to Keki Mistry of HDFC Limited, and he was talking about buoyancy in real estate. You also have, in your latest report, spoken about early signs of animal spirits in private capex related type of sectors like capital good industrials and even real estate. Would you build upon your hypothesis which you've highlighted in your report?
Yeah, so this is very important to note. I mean, typically when we talk about the CAPEX cycle, we talk about either how much government is spending or how much companies are spending. But if you break it up, the gross fixed capital formation, which is typically the investment rate, in 2012, and that's what we are observing, they contributed almost 37% to the overall investment rate. And that has gone down significantly. I mean, I'm talking about real estate from the household sector. And it's a decadal downtrend, cyclical downtrend that we've seen in contribution of real estate to the overall investment rate. I think that is turning. And if I were to go by our sector analysis of absorption of both real estate and residential and commercial real estate both, it's really picking up quite nicely and supported by also low mortgage rates. I mean, home owners are borrowing at a much lower rate than the government of India at this point in time. So, so the rates are low and the demand is good. And see, what we have observed over the last 30 years and that we have put up in the report is actually, even if interest rates were to go up or inflation were to be higher, that is not a negative. I mean, that has not resulted in a negative cycle for real estate, actually. It's more to do with the animal spirits, as you said. I mean, how people think about their future, whether, they feel that real estate prices will rise. And on the price front, we have observed that prices have been slowing down for the whole of last decade. And we are seeing some signs that it is bottoming out. So price trajectory of real estate will be an important factor. Once people realize that the slowdown in real estate prices is over, the confidence rises, and so that is how it moves. While rising inflation and interest rates have not been negatively correlated with real estate over long periods of time, if you see last 30 years. In fact, people do talk about real estate as an inflation hedge also, right? So so you have to look at it from a combination of demand, how income growths are rising, especially in the sectors which can allow people to buy homes. I mean, in a private corporate sector where the per capita income is higher, these are the people who can afford homes. I mean, so if that's rising, then I don't see, and if the confidence is rising on home prices, I think we are seeing the bottoming out of the real estate cycle, both on the residential and commercial space. I mean, going by data that's coming in, right?
I've looked at the numbers of potential earnings growth as well in your detailed research note in this direction. What kind of earnings growth signs do you see on a 2 to 3 year or maybe longer on a CAGR basis? And if you could share some of the names which are your top ideas within this perspective in your note.
Yeah, so from an earnings growth perspective, if you see last couple of years, we have seen the cyclical part of the market, be it corporate banks or industrials, telecom, they have been showing mean reversion of profitability from very depressed profits to coming to normalized profits. And now as demand rises, this can continue further. So from a, let's say, a Nifty earnings growth perspective, one can expect over the next 2 years close to 15-16% kind of earnings growth. While we think that the mid cap and small cap, especially those areas which were really impacted by the COVID, all the service related sectors, entertainment, leisure, travel and all, which were severely impacted by COVID, they largely reside in the mid and small cap space. I mean, small finance companies and all. I think there we will see higher earnings growth coming out of the COVID impacts as compared to the large caps. But that will only be for a year or so, this earnings outperformance. And beyond that, things will more or less merge at a rate which will be maybe slightly higher than the nominal GDP growth of 10-12%. But the upside risk is if operating leverage and financial leverage, the credit cycle starts picking up, then even the profit cycle can be much ahead of the GDP growth. That's how we look at it from a 1 or 2 years perspective and beyond. So operating leverage, financial leverage, these will be the key things to watch out once we come out of a situation where things were really down in terms of these aspects. And from spaces where we are seeing demand and valuation. So from a stock picking perspective, the spaces, it's more of value versus what growth one can expect. So we're clearly seeing that more conducive for sectors like corporate banks where credit cycle is expected to pick up, the utility space, telecom, cement, and some of these other industrial space, infrastructure development and all. There we see valuations reasonable, while growth should pick up as the investment cycle and economic recovery picks up. And obviously there will be the space where which will continue and which has been doing well in the export space. And now, as I said, discretionary consumption, some of the pent-up demand due to COVID and all for the last year or so, that will start reversing. So a combination of credit cycle related, industrial investment cycle related, pent-up discretionary consumption and exports. These are the spaces where one should look at names, which we can go through our report and see several names that we have put out. But these are themes one should be looking at where the growth is good and some of them have even reasonable valuations.
Right. Vinod, I really enjoy reading your reports. I must tell you once again, thanks so much for dropping by today and chatting with us regarding your observation on industrials and a case building in real estate as well. Thanks so much for your time. With that, it's a wrap out of Newsroom, but all the action from India Economic Conclave Day 2 from NCPA in Mumbai continues ET Now. Stay tuned.